Starbucks has hit a rough patch since their most recent earnings at the end of April. Negative growth, increased competition, and operating woes has tanked the stock almost 20% in recent weeks. Today I'm going to go through why I just bought 1,000 worth of their stock and why I think this is a golden opportunity for investors. I think it's prudent really to look at their chart first. So they reported earnings on the 30th of April and they were up at 88.49 and they immediately went down to 78.25, which is almost a 12% loss. In the following weeks, they went all the way down to all-time low in the most recent times to 72.22, which is almost a 20% decrease. Now, this is mainly attributed to the earnings, which we're going to go through the earnings report now. But there's also some operational woes that we're going to discuss and look at a few interviews. So what I've done here is I've taken their Starbucks earnings at a glance, and I also have their full record here of their official earnings. I'm going to link both of these in the description if you want to go through them as well. So there's a couple of things here, and you can really see it from the offset, right? Is, you know, their revenue is down. Their global, North American and international, specifically China as well, which was supposed to be a growth market for them, is down substantially with 11%, 3% in the US, and then 4% globally. So this is not a good story at all, right? You can see that their operating margin is down 140 basis points. Their non-GAAP, and by the way, GAAP is just generally accepted accounting principles, which is commonly used in these kind of reports. It's down 7%. Their store count is up. However, it isn't up as much as was expected. So they did add 6%. Their whole strategy at the moment was to grow stores and to get more revenues in through that. But what seems to be happening in their existing stores is revenues is going down. You know, this looks good, right? But it turns out it really isn't that good because it didn't grow as much as it was supposed to. This is all kind of just, you know, look good stuff, right? They're just saying one of their best products, you know, this is a bit of a silver lining. In the 90-day active members, it is up a little bit, right? But it doesn't really overshadow what's happening. We also look at the store growth. So as we were saying, 6%, 4%, 12%, right? Not as much as we were expecting. Their guidance, right, which is terrible again. So they were predicting, I believe before this, it was like, you know, 10, 15% growth. Now they're saying it's going to be flat in all regions, essentially. Maybe a little bit less so in China. Their global revenue is going to be flat. Their operating margin is going to be flat. Their capital expenditure just not looking good, right? So if we come over here to their more detailed report, right off the bat, we're seeing that 2% down in revenue. So that's an important metric. We also have a comment here by the CEO, which we'll hear from him in the interview in a minute. In a highly challenged environment, this quarter's results do not reflect the power of our brand, our capabilities, or the opportunities ahead. So, you know, even he's saying this is just not good, right? So one really important thing I also want to call out from this, and we'll move on then to the interview, is the forward-looking statements, right? So even their forward-looking statements in this report are terrible, right? So they're saying here, they're kind of blaming this on the boycotts due to the Palestine. Starbucks kind of got caught up a little bit in some of the protests and stuff in the US campuses that were being boycotted because they thought, you know, that maybe we were supporting Israel, which, you know, who knows. But it was kind of, I think it's kind of mistaken. So, but blaming that really isn't a good thing. They're also, you know, there's a couple of things here that there's going to be increase in logistic costs, you know, unfavorable global or regional economic situations. So I think they're probably calling out China here. Risks of, you know, global environment, geopolitical instability, really just, you know, a whole lot of stuff that really doesn't say what is going on at this company. Why are they down so much? You know, it used to be a great company. They were growing. So I think the best thing to do next is we're going to look at the interview with the CEO, which is with Jim Cramer. And I know, look, Jim Cramer, but he really hammers the CEO, and the CEO doesn't really have much to say about it. So I'm just going to play a bit of this, and I'll comment then at kind of key aspects of it, right, when Jim's going back and forth with the CEO. But you can make your own version of this, and I'll give my comments as we go through.
I've seen in a long time. Joining us now exclusively is Starbucks CEO Laxman Narasimhan. Mr. Narasimhan, it's good to have you on the show, and I appreciate that you're coming on, despite the fact that the quarter was extremely weak.
Jim, it was a very tough quarter. Thank you for having me. There were three reasons for this. First, We saw unexpected pressures on our occasional customers, more intense than we expected, that impacted their visitation. Second, the choppiness of the recovery in China continued with a more intense price war than what we expected. And third, challenges of our business in the Middle East that impacted us not just in the Middle East, but also in other geographies.
Okay.
Clearly,
I really think he's nitpicking here, right? So he's calling out certain regions like China and the Middle East, right? They're not really doing a whole lot of business in the Middle East, right? So that's kind of an easy one for him to say, oh, look, it's not great. The recovery in China, the idea was to grow in China. So I don't think you can really blame the whole pandemic we had on that, right? And then he's saying the point on the occasional customers, I think, is probably a good point, right? Looking at the data, you can see that people are probably seeing that it's a bit expensive to go to Starbucks, so they're not coming back. But let's see what else he has to say.
I understand. Now, what I'm trying to figure out, sir, is why did you not feel the need to pre-announce this shortfall, given the fact in the previous quarter, your CFO said that she felt that you could have a earnings per share growth in the range of 15 to 20%. This is a substantial decline from that. And given the...
Yeah, great point by Jim here, right? So all the forecasts were like 15, 20%, 10% here, 15 there, right? Whereas they didn't say anything before this earnings that they were going to be down so much. This is why the stock, has tanked so much.
The fact that you said on the call that April did not end well, I'd like to know why you did not feel the need to come out and say our quarter is going to be substantially worse than expected at least 4 weeks ago.
I think, Jim, we've been working on action plans to address these headwinds. And so what we wanted to come back with was not just the announcement, but also the action plans that we have in place, which, by the way, are not business as usual. And I'm happy to talk about them.
Well, let's finish, because I know that investors are trying to figure out why they should hold on to the stock. Some of the things that I am confused about, I checked with all the major, both public and private companies that are in a similar business to you, and no one saw a 3% decline in comp stores because of weather, and none of them saw a negative number except for you. Is it possible that your coffee is just too darn expensive?
Yeah, I think he hit the nail on the head there, right? So he was looking at similar businesses, I imagine, like Tim Hortons, McDonald's, etc., that didn't have declines. So really what I think is happening, one of the main things here is Starbucks increased their prices a little bit too much too fast, whereas the others didn't. They did a bit of more gradual increase. So when you're looking at comparable businesses and they're not seeing the decline, what does that mean? Is it an operational issue? Is it a CEO issue? Is it that they're increasing their prices too much?
If you look at the U.S. business and look at the fundamentals of the U.S. business, we are holding share in the U.S. We are still the largest player in out-of-home coffee. If you look at some of the metrics that we have...
Dunkin' Donuts, Tim Hortons said you are not holding share, sir. I regard them as being seminal companies that are just as good when it comes to... McDonald's says you are losing share. I can't go against those three companies. They are too good and too honest and too big for me to dismiss.
We are the...
Exactly, right? So they're losing share to all these other companies, and I would imagine mainly because of the prices, right? And he's just avoiding that whole situation. He doesn't really want to admit that.
Leading category player in coffee. I'm talking visitation share and what we have. If you look at our in-home coffee business, it grew share 140 basis points. But if you look at the business underpinning us, tea grew 8%, cold grew 1%. So there are elements in here. If you look at our partner sentiment and what we have inside stores, attrition is down to its lowest levels. So there's work going in. The thing we didn't do enough of is really attack the occasional customer with delivering and communicating value to them in a more aggressive manner.
Again, he's kind of nitpicking things here. He's saying that like certain elements of their products, like tea or cold brew or whatever, has grown, but I mean, they're a coffee company. That's what's down, right? And he's touching on here as the occasional customer again, that they're not relating value to them. He's talking about value, right? Like, their prices are up so much. You know, is it really worth going out of your way to get a Starbucks if the price is too much? He's going to go on to talk about the app, which is probably a good thing that they're doing. You know, they're doing offers and stuff to get people back in, which could improve next quarter, right, for their earnings
in a more aggressive manner. That's what the plan we have does.
Luxman, it's David. China continues to be a not unimportant part of the growth plan for this company. You cite fierce competition there, a slower than expected recovery. But to Jim's question again, why not sort of focus on improving things there and or fighting off the competition? You still are opening many stores. I know the net number was still a pretty significant one for the quarter in China.
David, first of all, I think if you look at the overall network of stores that we have, they're in very good health. If you look at the cash-on-cash returns that we get from the new stores and the expansion, they're 40% cash-on-cash returns. We see no reason to change that equation. It does not mean that we're not focused on fixing the challenges we have with the occasional customer. And with
yeah, I mean, like the figures say it all, right? North America, US down 3%, international declined 6%, China declined 11%, right? And their existing revenue in their existing stores are down as well, right? So they're not getting the new ones right, and they're not getting the existing ones right.
The fact that they're not visiting us as often.
Luxman, I was, noted your language in terms of citing a deteriorating economic outlook weighing on customer traffic. Do you really think that's the case? We talk about it endlessly here, as you well know, and it's far from clear that there really is a deteriorating economic outlook. So what is it you're seeing that perhaps many others are not?
Yeah, I mean, they can say that, but looking at the other vendors of coffee, right, McDonald's and Dunkin' Donuts and Hortons and all that kind of stuff, they didn't see a similar decline. So that's kind of a null point.
What we are seeing is pressures on the wallet for some of our most occasional customers. And they are translating that into what they're choosing to do.
All right, what are they doing then?
Well, so some of them are obviously visiting less, as we have seen, hence our action plan, which is about communicating value, which is about ensuring our speed of service improves, so we capture the demand that we already have. And thirdly, that we bring in products that they find exciting. What we are doing with products is, if you look at the lavender matcha, really appealed to some of these customers.
Yeah, you see, they had that in their high-level earnings report as well, you know, the specific type of coffee to bring people in, right? But I mean, sure, maybe their sales are up or whatever, but I don't think it's going to be like a massive draw.
We are bringing in new products as our seasonal launches go that are really appealing to these occasional customers as well. So it's about price, it's about value. We're bringing those two together to ensure that the occasional customers find it worth their while.
Yeah. Okay, I think we'll that's kind of the gist of it there on the interview, right? So you can take whatever you want from that. I think it was a disaster of an interview, right? He didn't really address like why revenue was declining in existing stores when their competition in other companies, McDonald's and Dunkin', didn't decline, and in their new stores they didn't open as many stores as they want to, and they have decline in China where they're opening loads of stores, or Latin America, etc. So it's really not a great look when a newer CEO comes on. It's a bad quarter and he's not really able to address the main points, and he kind of goes off and say we have action plans to resolve this and that, but it's not actually getting to the crux of the issue. One other important thing to mention is the kind of rivalry that's happening between the new CEO and the old CEO, Howard Schultz. So Howard Schultz actually not appointed, but he trained in this new CEO, right? And what seems to have been happening since the last earnings call is he's kind of come out and almost railed the new CEO with a post. So we had this article, and then this is kind of talking about this post here from Howard Schultz where he was saying he's no longer on the board. Things have kind of gone downhill since he's left, that the company, especially the senior leadership here, needs to go back to kind of the fundamentals and, kind of look at the company from when they're, working behind as a barista, right? And saying there's kind of no quick fixes, which is, I do kind of agree what he's saying. However, you know, he did train in this new CEO, and you would think he would be supportive for the company in the long run, but it doesn't really seem to be happening, right? So let's move over now and take a look at the fundamentals of Starbucks. So popping back over here to Trading 212 where we started. So we already went through the chart. So what I'm going to go through is really the fundamentals of the company. So, and we'll also talk about really where I stand with my position, okay? So scrolling down here, we can see they have a pretty good, you know, their EPS is 360, not terrible. They're a large company, large revenue, as to be expected. Their dividend yield, which I think is quite good for a company of their size, at 3%, right? So if we go in here and look at a few ratios, what I really want to look at is, first off, is the payout ratio at 60%. So that's the ratio to how much, you know, dividends they pay out. So 60% is high enough, but I think it is sustainable at their being a company of this size, right? We move over then to their margin. So I always look for double digits in the margin, over usually about 10-11%. So we can see that their 5-year average is about 11%, and their net profit margin here is 11.47 in the most recent fiscal year. So that's pretty good. Their cash flow, yeah, doesn't look too bad. I think growth really is the big one. So over 5 years, the revenue grew by 15.22%, with EPS growth of 6. Now that's pretty good. Earnings per share over 5 years, 65.84 is quite substantial, right? So that's very positive. We can also look at their net profit margin. So here we go. So this is kind of another reason why they're down, right? So minus 9.5%, so down 10% over 5 years. That is not a good sign. What is going on here? Their operating cash flow as well, not a great sign with the CAGR. Their dividend growth of almost 9%, that's positive for dividend investors like myself. So let's pop back over here and go into their financials. So starting off with the income statement. So if we go back here to 2021 and we close a few of these out, we really only want to look at the net income here is what I'm looking at. So 4.2 in 21, down to 3.28 in 22, and back up a bit to 4.12 in 23, right? Which is, you know, all right. If we look at this quarterly, which is kind of what we're focused on, let me see here. So in the last quarter, they 1.22, and then they went down slightly to 1.2. If we look at Q2 last year, so they're 908, and then Q1 this year. So it is, yeah, you know, it's not a terrible story. It did go down, you know, almost 200 million from quarter to quarter here. We pop over to the balance sheet. What I'm really looking at here is the assets and liabilities. So the total assets, total liabilities. So assets over the years. So we had 31 billion 21, down substantially in 22, 27, up again a little bit in 29 in 2023. And their liabilities 36, 36, 37. So their liabilities aren't crazy out of control, which is what I'm looking at. Cash flow, if we pop back here to 21, so we had 2 billion. We had okay, that's a bit of a red flag as well, 3.64, and then back up again a little bit in 2023. So I think all around, really, it's pretty positive in total. Like, their fundamentals are pretty good. Obviously, their recent quarter is bad, right? And I would also say the fact that their net profit, you know, it has been going down over the last 5 years is not a good sign. So if we go back here and look at my position in this, so I only bought last week. I bought like 15 shares, and you can see it's already back up, right? So I'm making €31 or 3% back up from when I bought it. I bought it at 73.60, and it's back up to 76, right? Looking at the position, right? So I have 15 shares. It's a value of almost 1,054. So I bought this, you know, I've kind of went through why I bought this. I think it's a golden opportunity to, you know, it went down 20%. I don't think the fundamentals are that bad. I don't think the news is all that bad. It's bad for this quarter, but it's easier to turn around now once you've addressed it. Once you see the problem, you can address the problem. So that's kind of all for this video on the Starbucks. Thank you for watching, and I'll catch you in the next one.